Today, we'll dive into funding and financial planning in business entrepreneurship for MBA students. Let's explore the table of contents. In this crash course on business entrepreneurship, we will cover the key topics related to funding and financial planning. We will discuss the introduction to funding, sources of funding, financial planning for entrepreneurs, budgeting and forecasting, managing cash flow, funding strategies, and analyze case studies and examples. Let's dive in. In this chapter, we will explore the essential elements of funding and financial planning in the context of business entrepreneurship. These concepts are crucial for the prosperity of any entrepreneurial venture. So let's dive in and uncover the key insights together. In this chapter, we will delve into various funding options available to entrepreneurs, such as bank loans, angel investors, venture capital, crowdfunding, and bootstrapping. Each of these options comes with its own set of advantages and disadvantages, so it's crucial for entrepreneurs to carefully consider which aligns best with their business goals and financial needs. Additionally, we will explore essential financial planning tools like creating financial. All right, class. Today, we're diving into the world of funding options for your entrepreneurial venture. From venture capital to angel investors, crowdfunding, and bootstrapping, there are various ways to secure funding for your business. Each option comes with its own set of pros and cons, so it's crucial to carefully assess which one aligns best with your business goals and financial needs. Let's explore these funding options further to help you make informed decisions for your startup. In this slide, we will delve into the various funding options available to entrepreneurs in the realm of business entrepreneurship. Venture capital is a popular choice where investors provide funding to startups with long-term growth potential in exchange for equity. These investors not only inject capital, but also offer guidance and expertise to help the company succeed. Angel investors, on the other hand, are wealthy individuals who invest their own money in startups, bringing industry experience and valuable mentorship. Crowdfunding is another avenue, allowing entrepreneurs to raise capital from a large pool of individuals through online platforms with options like reward-based, equity, and donation-based crowdfunding. Lastly, bootstrapping involves funding a business using personal savings or revenue, enabling entrepreneurs to maintain control and independence without taking on debt or giving up equity. Each funding option has its pros and cons, and entrepreneurs must carefully consider which aligns best with their business goals and financial needs. Venture capital is a key source of funding for startups with high growth potential. Some well-known venture capital firms, like Sequoia Capital, Andreessen Horowitz, and Accel Partners, have made successful investments in companies like Airbnb, Uber, and Facebook, helping them grow into billion-dollar businesses. These investments not only support innovation, but also drive economic growth by backing new ideas that can disrupt. Angel investors like Peter Thiel, Reid Hoffman, and Ashton Kutcher are key players in the startup ecosystem, providing crucial capital in exchange for ownership equity. Their successful investments in companies such as Facebook, LinkedIn, and Uber have not only yielded significant returns, but have also brought valuable expertise and connections to the startups they support. This involvement can be a game changer for entrepreneurs looking to scale their ventures and attract further funding from other sources. The impact of angel investors goes beyond just financial support, as they play a vital role in helping startups grow and succeed in the competitive business landscape. Crowdfunding is a method of raising capital through the collective effort of friends, family, customers, and individual investors. Popular platforms like Kickstarter, Indiegogo, and GoFundMe have made it easier for entrepreneurs to showcase their ideas and attract funding from a wide audience. Successful campaigns such as the Pebble smartwatch and Oculus Rift have demonstrated the power of crowdfunding in helping entrepreneurs bring innovative products to market. Overall, crowdfunding can be a valuable tool for entrepreneurs looking to raise capital, validate their business ideas, and engage with potential customers and investors. Leveraging the collective power of the crowd, entrepreneurs can turn their visions into reality and create successful businesses. Bootstrapping is all about starting a business with minimal external resources or capital. This method involves self-funding the business, relying on revenue from early customers, and operating on a shoestring budget. For instance, think of starting a software company in a garage or launching an online store with limited inventory. These are classic examples of bootstrapping in action. The founders use their own funds to develop the product and gradually grow the business without external investment. This approach can be a practical choice for entrepreneurs who want to maintain control over their business and avoid taking on debt or giving up equity. It requires careful financial planning and resourcefulness, but in the end, bootstrapping can lead to sustainable growth and long-term success. Today, we will be discussing the importance of financial planning tools for entrepreneurs in our Business Entrepreneurship crash course. These tools, such as financial projections, break-even analysis, and cash flow management, are essential for creating a solid financial plan and ensuring the long-term success of a business. Let's dive in and explore how these tools can help entrepreneurs effectively manage their finances and make informed decisions. Financial projections, break-even analysis, and cash flow management are crucial financial planning tools for entrepreneurs. Financial projections help forecast future revenues, expenses, and profits, enabling informed decision-making and risk identification. Break-even analysis determines the point where total revenues equal total expenses, guiding entrepreneurs on sales targets to cover costs and generate profits. Cash flow management involves monitoring and optimizing cash flow to meet financial obligations and invest in growth. These tools are essential for entrepreneurs to make informed decisions, manage risks, and achieve long-term business success. Financial projections are crucial for business entrepreneurs as they serve as a roadmap for future financial performance. This involves evaluating how significant the feature is to the overall product, the potential impact it may have on users, and whether it is feasible to implement within the given constraints. By focusing resources on critical aspects, teams can ensure that they are allocating their time and effort effectively. This means prioritizing features that align with the core value proposition of the product and have the potential to drive user engagement and satisfaction. For instance, in developing a new mobile app, understanding the importance of features like user authentication, payment processing, and push notifications can help prioritize which features to focus on first. By assessing the impact of these features on user experience and the feasibility of implementing them within the project timeline, teams can make informed decisions on where to allocate their resources. Feature prioritization is an iterative process that may require constant reassessment as new information becomes available. By regularly evaluating the importance, impact, and feasibility of features, teams can ensure that they are building a minimum viable product that meets the needs of their target market while staying within resource constraints. Break-even analysis is a vital tool for entrepreneurs as it helps determine the point where total revenue equals total costs. For instance, if you are selling a product for $10 with variable costs of $5 per unit and fixed costs of $50,000, you would need to sell 10,000 units to break even. This analysis is crucial for entrepreneurs to grasp the minimum sales required to cover all costs and start generating a profit. Understanding the break-even point enables entrepreneurs to make informed decisions regarding pricing strategies, production levels, and overall business sustainability. It is essential to regularly review and update break-even analysis as costs and market conditions may fluctuate over time. Cash flow management is crucial for businesses as it involves closely monitoring, analyzing, and optimizing the flow of cash in and out of the company. This ensures that businesses have enough liquidity to meet their financial obligations, such as paying suppliers and employees on time. Moreover, Effective cash flow management enables businesses to seize growth opportunities by having a positive cash flow that allows for investments in new equipment, expansion of operations, or the launch of new product lines. Conversely, poor cash flow management can result in cash shortages, missed opportunities, and potential bankruptcy. By implementing strategies like creating cash flow forecasts, negotiating favorable payment terms with suppliers, and efficiently managing inventory levels, businesses can enhance their cash flow management. This, in turn, helps them maintain financial stability and work towards achieving long-term success. Today, we're diving into the world of financing with a focus on equity and debt. Equity financing means selling ownership shares, while debt financing involves borrowing money to be paid back with interest. Understanding the pros and cons of each is crucial for making informed financial decisions in your entrepreneurial journey. Equity financing is a method of raising capital by selling shares of ownership in a company. One common example of equity financing is selling shares to venture capitalists who provide funding to startups and small businesses in exchange for equity ownership. Another example is issuing new shares of stock, such as through an initial public offering, IPO, where shares are sold to the public for the first time. This allows companies to raise significant capital for growth and expansion plans. Equity financing can be a valuable funding source for businesses with high growth potential, as it provides access to capital without taking on debt and aligns investor interests with business success. However, it also means giving up a portion of ownership and potentially some control over decision-making. In the context of rapid experimentation, startups and companies utilize different strategies to optimize their products and services. Startups, for example, may test various pricing strategies by offering their products at different price points to determine what resonates best with customers. All right, class. Today we're diving into the stages of funding in entrepreneurship, starting with seed funding for that initial capital, moving on to Series A funding once the concept is proven. Each stage presents its own challenges and opportunities for entrepreneurs to tackle. Let's explore how to navigate these crucial steps in financial planning for your business. Seed funding is crucial. Entrepreneurship, mastering sales techniques is crucial for effectively selling products or services. From building rapport with customers to closing the sale, these strategies are essential for entrepreneurs looking to boost their sales and grow their business successfully. Series A funding is a critical stage for companies aiming to grow and expand their market presence. This type of funding is essential for activities such as product development, market expansion, and conducting clinical trials. Tech startups often rely on Series A funding to enhance their products and services and reach new customers in different markets. Similarly, biotech companies frequently use Series A funding to support the expensive clinical trials needed for new drug development. In essence, Series A funding is instrumental in helping companies achieve their strategic goals by providing the capital needed to drive their expansion efforts. Today, we're diving into the world of key financial metrics. These metrics, such as valuation, ROI, and burn rate, are vital for entrepreneurs to understand the financial health of their business. By tracking and analyzing these metrics, entrepreneurs can make informed decisions that will lead to long-term success. In this slide, we will delve into key financial metrics that are crucial for entrepreneurs in the business world. Valuation is essential for determining the worth of a business, attracting investors, and making strategic decisions. For instance, having a clear valuation can help negotiate fair deals with potential investors when seeking funding. Return on investment, ROI, is another important metric that measures the profitability of an investment relative to its cost. Understanding ROI is vital for assessing investment success and making informed decisions about future investments. For example, calculating the ROI of a marketing campaign can determine its effectiveness in generating revenue. Burn rate is the rate at which a company spends its available capital, and it is crucial for startups to monitor to avoid running out of funds too quickly. By calculating the burn rate, entrepreneurs can estimate how long their funds will last and make necessary adjustments to their financial planning. If a startup has a high burn rate, they may need to focus on increasing revenue or securing additional funding to sustain their operations. These financial metrics play a significant role in the financial planning and success of a business venture. Valuation is crucial in the world of business and entrepreneurship, as it determines the current worth of a company or an asset. This is essential for making investment decisions, acquisitions, and partnerships. For instance, when a startup is looking for funding from venture capitalists, having a clear valuation of the company is vital. It helps both the startup and the investors understand the potential growth and profitability of the business, influencing the investment decision. Valuation also plays a significant role in mergers and acquisitions. Knowing the value of a company can aid in negotiating the terms of the deal and ensuring that both parties receive a fair share of the value being exchanged. In essence, valuation is not just a number on paper. It is a strategic tool that can impact various aspects of business decision-making and financial planning. The calculation for ROI is simple. Gain net cost, sware cost. This formula allows businesses to assess how much they are gaining from an investment relative to the cost incurred. For example, let's say a company invests $10,000 in a marketing campaign that results in $50,000 in sales. The ROI for this investment would be calculated as follows. $50,000, $10,000, $10,000 equals 4. This means that for every dollar invested in marketing, the company generated $4 in return. Understanding ROI is essential for businesses to make informed financial decisions and allocate resources effectively. By analyzing the ROI of different investments, companies can prioritize projects that offer the highest returns and maximize their profitability. Burn rate is a crucial metric that measures how quickly a company is spending its available capital. It is essential for entrepreneurs and business owners to closely monitor their burn rate as it directly impacts the financial health and sustainability of the business. One of the key reasons why burn rate is important is that it helps determine the runway before the company runs out of money. For example, if a company has a monthly burn rate of $50,000 and $500,000 in the bank, it means that the company has a 10-month runway before it exhausts its funds. This information is vital for making strategic decisions regarding fundraising, cost-cutting measures, and overall financial planning. Understanding the burn rate can also help entrepreneurs identify potential cash flow issues and take proactive steps to address them. By keeping a close eye on the burn rate, businesses can adjust their spending habits, explore new revenue streams, or seek additional funding to extend their financial runway. In conclusion, monitoring the burn rate is a critical aspect of financial planning for entrepreneurs and business owners. It provides valuable insights into the company's financial health, helps in making informed decisions, and ensures the long-term sustainability of the business. In this chapter's summary, we've covered the crucial funding options and financial planning tools that entrepreneurs need to know. From venture capital to bootstrapping, we discussed key financial metrics to help entrepreneurs make informed decisions for their business ventures. In this chapter, we delved into different funding options and financial planning tools such as venture capital, angel investors, crowdfunding, and bootstrapping. We also covered key financial metrics like ROI, burn rate, and valuation. Thank you for your attention. Any questions? In wrapping up, always keep in mind that securing funding and having a solid financial plan are essential components of entrepreneurship. Stay proactive in seeking opportunities and managing your resources wisely. Thank you for your attention. Any questions?